All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another financial headline that gets forgotten by tomorrow. This is about a coordinated global realignment happening right now, in real time, that will fundamentally alter the value of every dollar you hold. The US dollar is being systematically replaced as the world's reserve currency. And when this process accelerates past the point of no return, your cash purchasing power will not decline gradually over years. It will drop 30 to 40% in a matter of months, possibly weeks. This is not a crash. This is not a currency crisis in the traditional sense. This is a controlled demolition of dollar dominance engineered by central banks, facilitated by international institutions, and already being implemented through bilateral trade agreements that bypass the dollar entirely. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus over 40 additional countries that have expressed interest in joining, are building an alternative settlement system. Saudi Arabia, the linchpin of the petrodollar system for 50 years, has chosen not to renew its exclusive oil for dollars agreement and is now accepting yuan, rupees, and other currencies for crude oil sales. The International Monetary Fund has been quietly expanding special drawing rights as a bridge currency, and the Bank for International Settlements has launched Project mBridge, a cross-border payment platform that settles transactions in multiple currencies without touching the dollar. These are not proposals. These are operational systems that went live in 2025. The infrastructure for de-dollarization is already built. The question is not if your dollar loses value. The question is whether you understand what's happening in time to protect yourself. In this video, I'm going to walk you through the exact mechanism of how reserve currency transitions work, why the historical precedent shows a 30 to 40% devaluation is not just possible but probable, and most critically, the 3 moves you need to make right now to position yourself on the right side of this wealth transfer. This is not about doom. This is about pattern recognition, preparation, and asymmetric opportunity. So stay with me, because by the end of this breakdown, you'll have a framework that most institutional investors are only beginning to understand. Let me introduce you to the concept that will govern everything we discuss today. It's called reserve currency transition mechanics, and it's the least understood but most important dynamic in global finance. A reserve currency is the currency that other countries hold in their central bank vaults to conduct international trade, to settle debts, and to stabilize their own currencies. For the last 80 years, that currency has been the US dollar. After World War II, the Bretton Woods Agreement established the dollar as the global reserve, backed first by gold and then, after 1971, by nothing but trust in US economic and military dominance. Here's why this matters to you. When your currency is the global reserve, your country gets an extraordinary privilege. You can print money, and the rest of the world absorbs the inflation by holding your currency. You can run massive trade deficits because other countries need to accumulate your currency to do business. You can borrow at artificially low interest rates because there's always demand for your bonds. This is called exorbitant privilege, and it's allowed the United States to live beyond its means for decades. But here's the mechanism most people miss. That privilege is not permanent. It's conditional on the rest of the world believing your currency is stable, that your institutions are trustworthy, and that holding your currency is safer than the alternatives. The moment that belief erodes, the transition begins. And it doesn't happen slowly. It happens in stages, long periods of gradual decline followed by sudden cascading shifts that catch everyone off guard. We are at the beginning of that cascade right now. The signs are not subtle if you know what to look for. Global dollar reserves as a percentage of total central bank holdings have declined from 72% in 2000 to under 58% in 2025. That's a 14 percentage point drop in 25 years. But the acceleration is what matters. Half of that decline has happened in just the last 5 years. Central banks are dumping dollars, not slowly, but in coordinated waves. At the same time, gold purchases by central banks hit record levels in 2025. Over 100 tons were added to official reserves, the highest annual accumulation since 1950. This is not portfolio diversification. This is preparation for a post-dollar system. China alone has increased its official gold reserves by over 300 tons in the last 18 months. And the unofficial number, the gold held by state-owned entities and sovereign wealth funds, is likely 3 to 5 times higher. Russia has been dumping U.S. treasuries and accumulating gold since 2014, and their reserves are now over 2,300 tons, making them the 5th largest holder in the world. India, Turkey, Poland, Singapore, all of them are moving in the same direction. They are trading paper dollars for physical gold because they see what's coming. Now, the asymmetric framework I want you to understand is this. When a reserve currency loses its status, the transition creates winners and losers. The losers are those holding the old currency and financial assets denominated in that currency. The winners are those holding hard assets, commodities, and the currencies or settlement mechanisms that replace the old system. The wealth transfer is not gradual. It happens in a repricing event where decades of accumulated imbalances adjust in months. Your goal is not to predict the exact date. Your goal is to position yourself before the majority realizes what's happening, and that window is closing fast. To understand what's about to happen, you need to see how this has played out before because reserve currency transitions follow the same pattern every single time. The most instructive example is the British pound. In 1920, the pound sterling was the world's dominant reserve currency. The British Empire controlled a quarter of the globe. London was the financial capital of the world, and the pound was considered as stable as gold itself. But underneath that appearance, the foundation was rotting. Britain had financed World War I by borrowing heavily and printing money. The empire was overextended, and the United States was rising as an economic and military power. The transition from pound to dollar as the dominant reserve currency took roughly 25 years, from 1920 to 1945, but the wealth destruction was not spread evenly over that period. It happened in 3 sharp devaluations. The first was in 1931, when Britain abandoned the gold standard and the pound lost 30% of its value in 6 months. The second was in 1949, when the pound was officially devalued by 30% against the dollar. And the third was in 1967, another 14% devaluation. If you held pounds through that entire transition, you lost over 60% of your purchasing power in real terms. But here's the critical insight. The people who saw it coming, who moved their wealth into dollar-denominated assets, into gold, and into hard assets before those devaluations, didn't just preserve their wealth, they multiplied it. The same pattern played out when the Dutch guilder lost reserve status in the 1700s and when the Spanish real collapsed in the 1600s. Every reserve currency transition in history has followed the same sequence: overextension and debt accumulation, loss of credibility and trust, a slow decline in reserve holdings, a sudden devaluation event triggered by a crisis or policy decision, and a rapid shift to the next dominant currency. We are currently in stage 3, the slow decline accelerating into stage 4. And the catalyst is already in motion. Let me show you exactly what's happening right now because this is not theoretical, this is operational. In March of 2023, Saudi Arabia and China completed their first oil transaction settled in yuan. That was the first crack in the petrodollar system. By mid-2024, Saudi Arabia officially announced it would not renew the 50-year petrodollar agreement that required all oil sales to be denominated in US dollars. That agreement, signed in 1974, was the foundation of dollar dominance. It meant that every country needed dollars to buy oil, which created artificial demand for the dollar and allowed the US to run deficits without consequence. That system is now over. Saudi Arabia is accepting yuan, euros, rupees, and even exploring digital settlement currencies. The demand for dollars has structurally declined, and there's no mechanism to reverse it. At the same time, the BRICS nations have been building an alternative financial architecture. The new development bank, headquartered in Shanghai, is now issuing loans in local currencies, not dollars. The BRICS Pay system, a cross-border payment network that bypasses SWIFT, is in pilot testing and expected to go fully operational in 2026. Over 40 countries, including Indonesia, Argentina, Egypt, and the UAE, have expressed interest in joining BRICS or using its financial infrastructure. This is not a fringe movement. This represents over 45% of the global population and a growing share of global GDP. Now, the most significant development, and this is the one that almost no one is talking about, is Project mBridge. This is a wholesale central bank digital currency platform launched by the Bank for International Settlements in collaboration with the central banks of China, Thailand, the UAE, and Saudi Arabia. It allows cross-border payments and settlements between central banks in multiple currencies without converting to dollars. The first live transactions were completed in 2025, and the platform is now being expanded to include additional countries. This is the infrastructure for a post-dollar world. It's not theoretical, it's operational. And every transaction that runs through mBridge is one less transaction that requires dollars. Now let's connect this to the domestic situation in the United States because the internal dynamics are amplifying the external pressures. The U.S. federal debt is now over $36 trillion. The interest payments on that debt exceeded $1.1 trillion in 2025, which is more than the defense budget. And those numbers are accelerating. The Congressional Budget Office projects that by 2030, debt servicing costs will be the single largest line item in the federal budget, larger than Social Security, larger than Medicare, and larger than all discretionary spending combined. This is mathematically unsustainable. And here's the mechanism that makes it catastrophic. As long as the dollar is the reserve currency, the U.S. can issue debt and foreign central banks buy it to hold as reserves. But the moment dollar reserve demand declines, the buyers disappear. The Treasury still needs to issue debt to fund deficits, but now it has to offer higher interest rates to attract buyers. Higher rates mean higher debt servicing costs, which means larger deficits, which means more debt issuance, which means even higher rates. This is a debt spiral, and there are only three ways out. Austerity, which is politically impossible in the United States. Default, which would collapse the financial system. Or inflation, which means printing money to pay the debt and devaluing the currency. Historically, governments always choose option 3, and that's what's coming. The Federal Reserve will be forced to monetize the debt, which means creating new dollars to buy Treasury bonds that no one else wants. This is how you get a 30 to 40% devaluation, not through a single policy announcement, but through the cumulative effect of money printing, loss of reserve status, and capital flight out of dollar-denominated assets. Now let me show you the mathematical mechanism of why 30 to 40% is not a worst-case scenario. It's the baseline. Right now, there are approximately $2.3 trillion in physical U.S. dollars in circulation globally. But when you include all dollar-denominated deposits, euro dollars, and dollar-based financial instruments, the total is over $90 trillion. The vast majority of those dollars are held outside the United States, primarily by foreign central banks, corporations, and investors, who need them for trade settlement. If even 20% of those holders decide they don't need to hold as many dollars because they can settle trade in yuan, euros, or other currencies, that's $18 trillion in selling pressure. When you sell dollars, you're buying something else: gold, euros, yuan, real assets, commodities. The dollar depreciates and the assets you're buying appreciate. Now, the U.S. imports over $3 trillion in goods and services annually. If the dollar loses 30% of its value, the cost of those imports rises by 30%. That's $900 billion in additional costs that get passed on to consumers as inflation. Gasoline prices rise, food prices rise, electronics, clothing, everything imported becomes more expensive. And since the U.S. imports far more than it exports, the inflationary impact is severe. This is the mechanism of devaluation. It's not a stock market crash. It's a purchasing power collapse. Your bank account still says $100,000, but what that $100,000 can buy has fallen by 30 to 40%. You haven't lost money in nominal terms. You've lost wealth in real terms. And most people won't understand what happened until they go to the grocery store and realize everything costs 40% more than it did a year ago. Now I need to walk you through a critical historical case study that will show you exactly how fast this can happen and why the 30 to 40% figure is not an exaggeration. Let's talk about the Plaza Accord of 1985. This was a coordinated agreement between the United States, Japan, Germany, France, and the United Kingdom to deliberately devalue the U.S. dollar, which had become overvalued and was hurting American exports. The dollar was trading at 260 yen in February 1985. Within 18 months of the Plaza Accord being signed, the dollar had fallen to 150 yen. That's a 42% devaluation in less than 2 years. And this was not a chaotic collapse. This was a managed, coordinated policy decision. Yet the wealth transfer was massive. Japanese investors holding dollar-denominated bonds lost over 40% of their wealth in yen terms. American companies with foreign operations saw their overseas earnings collapse when converted back to dollars. The ripple effects lasted for years. The lesson here is that even in a controlled scenario, currency devaluations of 30 to 40% can happen rapidly, and what we're facing now is not controlled. This is a loss of confidence happening in real time across multiple fronts simultaneously. Let me give you another example that's even more relevant. In the 1970s, after President Nixon closed the gold window and ended dollar convertibility to gold, the dollar entered a decade-long bear market. Against a basket of major currencies, the dollar lost approximately 35% of its value between 1971 and 1980. But that's just against other fiat currencies. Against gold, the loss was catastrophic. Gold went from $35 per ounce in 1971 to over $800 by 1980. That's a 96% loss in the dollar's value relative to gold. If you held cash or bonds during that period, you were destroyed. But if you held gold, you not only preserved your wealth, you multiplied it 20-fold. The pattern is consistent across every reserve currency transition and every major devaluation event in history. The currency loses value, hard assets reprice higher, and the wealth transfer from those holding paper to those holding tangible assets is swift and irreversible. Now let's talk about what's happening right now in the credit markets, because this is the early warning system that most people are ignoring. Corporate bond spreads, the difference between what risky borrowers pay versus safe borrowers, have been widening steadily since mid-2024. Investment-grade corporate bonds are now yielding 200 basis points above treasuries, up from 100 basis points a year ago. High-yield bonds are at 500 basis points over treasuries. This widening tells you that investors are demanding higher compensation for risk. They don't trust that these bonds will be paid back in dollars that hold their value. At the same time, we're seeing a surge in corporate bankruptcies. Chapter 11 filings in the United States increased by 40% in 2025 compared to 2024. These are companies that loaded up on cheap debt during the zero-rate era and now cannot service that debt at current interest rates. When companies go bankrupt, bondholders take losses. And when bondholders take losses, they demand even higher yields on new debt. This creates a vicious cycle that accelerates the stress in the system. The credit market stress we're seeing is a leading indicator of broader systemic problems. It's telling you that the financial system is under pressure and that pressure is building, not releasing. Now let's talk about what's happening in the Treasury market, because this is where the dollar's reserve status lives or dies. Foreign holdings of U.S. Treasury securities have been declining steadily. China, once the largest foreign holder, has reduced its Treasury holdings from over $1.3 trillion in 2013 to under $800 billion today. Japan has been a more stable holder, but even they have started reducing positions. The Middle Eastern oil exporters, who have been recycling petrodollars into treasuries for 50 years, are now diversifying into other assets. The trend is clear. Foreign demand for U.S. debt is declining at exactly the moment when the U.S. needs to issue record amounts of debt to fund its deficits. When foreign buyers step back, domestic buyers have to step in. That means U.S. banks, pension funds, and ultimately the Federal Reserve. But domestic buyers have limits. Banks are already holding record levels of treasuries and are facing unrealized losses as bond prices have fallen. Pension funds have allocation limits, and the Federal Reserve, if they step in to buy treasuries in size, that's money printing, that's monetization, and that's the mechanism that triggers the devaluation we've been discussing. The Treasury market is telling you that the game is changing, the buyers are disappearing, and when the buyers disappear, prices fall and yields rise. Higher yields mean higher borrowing costs for the government, and the debt spiral accelerates. Let me walk you through the three asymmetric plays that position you to not just survive this transition, but to profit from it. The first play is physical gold and silver, and I need to be very clear about why this is not just a hedge, but the primary wealth preservation tool in a reserve currency transition. Gold has been the ultimate form of money for over 5,000 years across every civilization. It has no counterparty risk, it cannot be printed, debased, or digitally confiscated. And most importantly, it is the asset that central banks themselves are accumulating right now. When central banks are buying something in record quantities, you should be paying attention. Gold is currently trading around $2,700 per ounce. But in real terms, adjusted for the expansion of the money supply and inflation, gold should be trading closer to $4,000 to $5,000 per ounce just to match its 1980 inflation-adjusted high. That means there's a 50 to 80% upside just to reach fair value. And if we get a true reserve currency transition where global demand for gold as a settlement asset increases, we're looking at $8,000 to $10,000 per ounce or higher. Silver is even more asymmetric. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 88 to 1. The historical average is closer to 60 to 1, and during monetary crises, it compresses to 30 or even 15 to 1. That means silver is undervalued relative to gold by a factor of 2 to 3 times. And because the silver market is much smaller than gold, the price moves are more violent. A doubling in gold could mean a tripling or quadrupling in silver. The move here is to allocate a minimum of 15 to 25% of your liquid net worth into physical gold and silver, not ETFs, not mining stocks, not paper certificates. Physical metal that you either hold yourself or store in a fully allocated, segregated vault outside the banking system. This is not a trade. This is insurance that pays off when the system breaks. You want to work with reputable dealers. You want to focus on bullion coins and bars with low premiums over spot price. American Gold Eagles, Canadian Maple Leafs, and 1-ounce bars from recognized refiners like PAMP or Credit Suisse. For silver, look at American Silver Eagles, Canadian Maple Leafs, or 100-ounce bars. Avoid numismatic coins or collectibles. You're buying weight, not rarity. The second asymmetric play is currency diversification and hard asset exposure. If the dollar is losing reserve status, that means other currencies are gaining relative strength. The Chinese yuan is being positioned as a trade settlement currency, backed by gold and commodity reserves. The euro, despite its own structural problems, benefits from dollar weakness because it's the second largest reserve currency. And Swiss francs, Norwegian kroner, and Singapore dollars all represent stable jurisdictions with strong rule of law and fiscal discipline. The move here is not to go all in on a single alternative currency, because all fiat currencies are being debased to some degree. The move is to hold a basket of currencies and reduce your concentration in dollars. You can do this through foreign bank accounts if you have significant wealth, through currency ETFs, or through hard assets denominated in other currencies. Real assets are the other side of this trade. Productive farmland, energy infrastructure, timber, water rights, these are assets that generate value in the real economy independent of what happens to paper currencies. When currencies devalue, hard assets reprice higher in nominal terms to reflect the loss of purchasing power. If you own farmland that produces food, that land becomes more valuable as food prices rise. If you own energy assets, they become more valuable as energy becomes more expensive in dollar terms. The key is to own things that have intrinsic utility and cannot be printed into existence. Farmland in stable regions with good water access and productive soil is one of the best long-term stores of value. Energy royalties or direct ownership in oil and gas production, timberland that produces sustainable harvest income. These are assets that the ultra-wealthy have been accumulating quietly, while retail investors chase meme stocks and crypto speculation. The third asymmetric play is precious metals mining equities, specifically senior producers with Tier 1 assets and strong balance sheets. This is the leverage play on the gold and silver thesis. When gold moves from $2,700 to $4,000 per ounce, a mining company with an all-in sustaining cost of $1,400 per ounce goes from earning $1,300 per ounce in profit to $2,600 per ounce. That's a doubling of profit margins, which typically translates to a tripling or more in the stock price. The risk here is operational, political, and jurisdictional. Mining is a difficult business and not all companies are well run. But the asymmetry is undeniable. You're buying companies trading at single-digit price-to-earnings ratios in some cases, with massive operating leverage to a gold price that is set up to move significantly higher. The companies to focus on are the ones operating in stable jurisdictions like Canada, Australia, and the United States. Companies with strong management teams, low debt, and a track record of operational execution. Names like Newmont, Barrick Gold, Agnico Eagle, and Franco-Nevada for gold. For silver, companies like First Majestic, Hecla Mining, and Pan American Silver. These are not speculative juniors. These are large-cap producers that will benefit massively from a sustained move in metal prices. Now let's talk about the catalysts that will accelerate this transition from a slow grind to a rapid cascade. And I want to be very clear, the transition is already happening. These catalysts will determine the speed, not whether it occurs. The first catalyst is a sovereign debt crisis in a major economy. Japan, with a debt-to-GDP ratio over 260%, is the most vulnerable. If Japan faces a funding crisis where they cannot roll over their debt at affordable rates, it will trigger a global flight out of government bonds and into hard assets. The Bank of Japan has already been forced to intervene multiple times to defend the yen, and their options are narrowing. They're trapped between allowing the yen to collapse or raising rates and triggering a debt crisis. Either outcome accelerates the global move away from fiat currencies. The second catalyst is a major geopolitical event that undermines confidence in U.S. institutions. This could be a military conflict, a domestic political crisis, or a loss of credibility in U.S. financial markets. The specifics don't matter. What matters is that confidence in the dollar is based on perception, and perception can shift overnight. We saw this in a limited way in 2023 when the regional banking crisis unfolded. Depositors pulled $500 billion out of the banking system in a matter of weeks. Now imagine that happening at a global scale with foreign central banks pulling reserves out of dollars. The cascade would be swift and severe. The third catalyst is the official launch of a BRICS reserve currency or the expansion of digital settlement systems like mBridge to the point where they handle a critical mass of global trade. Once these systems reach 20 to 30% of global trade flows, the network effects kick in and adoption accelerates exponentially. Countries that are currently fence-sitting will see the momentum and join to avoid being left out. This creates a tipping point where dollar demand falls off a cliff, and once that happens, there's no going back. Any one of these catalysts could trigger the cascade, and the cascade doesn't give you time to react. By the time it's obvious to everyone, the devaluation has already happened. The gold price has already doubled. The mining stocks have already tripled. And the average investor is left trying to buy at the top. So what do you do right now? First, you need to audit your financial exposure. If more than 75% of your net worth is denominated in US dollars, held in US bank accounts, or invested in dollar-based financial assets, you are overexposed to the exact risk we've been discussing. The action is to rotate a significant portion, at minimum 20 to 30%, into physical precious metals and hard assets. This is not radical. This is prudent risk management in an environment where the rules are changing. Second, you need to establish redundancy in your financial infrastructure. This means opening accounts in foreign jurisdictions if you have the capital to do so. It means exploring offshore storage for precious metals. And it means understanding the legal and tax implications of holding assets outside the US. This is not about hiding money. This is about diversification and protection against a system that is showing structural stress. If you have significant wealth, work with an attorney who specializes in international asset protection. Set up structures that create separation between you and your assets so that, in a crisis, they're not easily frozen or confiscated. Third, you need to reduce your exposure to long-duration U.S. Treasuries and dollar-denominated bonds. These are the assets that will get destroyed in a devaluation scenario. If you own bonds, move to shorter duration, inflation-protected securities like TIPS, or rotate into real assets entirely. Every dollar you have in 10-year or 30-year treasuries is a dollar at risk of significant principal loss if yields spike. Fourth, you need to educate yourself continuously. The information I'm sharing with you right now is not coming from CNBC, Bloomberg, or the Wall Street Journal. Mainstream financial media is 6 to 12 months behind the actual policy and market dynamics. You need to follow central bank speeches, read the Bank for International Settlements reports, and understand what the smart money is doing. Follow independent analysts who understand monetary history and reserve currency transitions. Read the work of economists like Jim Rickards, Luke Gromen, and Lynn Alden, who have been tracking these developments in real time. Fifth, you need to act with urgency but without panic. This is not about liquidating everything tomorrow. This is about making strategic moves over the next 3 to 6 months to reposition your portfolio before the window closes. The people who wait for confirmation, who want to see the devaluation happen before they act, will be the ones who lose the most, because by the time it's confirmed, the assets you need to own will have already repriced higher and the opportunity will be gone. Here's the question I want you to answer in the comments. What percentage of your net worth is currently held in physical gold and silver, and what's the biggest obstacle preventing you from increasing that allocation? Is it skepticism about the thesis, lack of knowledge about how to buy and store metals, concerns about liquidity, or something else? I read every comment, and the collective intelligence of this community is one of the most valuable resources we have. Your insights help others who are facing the same questions. If you found this breakdown valuable, if you understand why this matters and why the timeline is compressing, I need you to do 2 things right now. First, hit that subscribe button and turn on notifications. This channel exists to give you the information and frameworks that the mainstream will not provide until it's too late. We go deep, we go early, and we focus on actionable intelligence. I'm tracking these developments daily, and you need to be plugged in as this unfolds. Second, share this video with someone who needs to hear it. The people who are going to be hurt the most by this dollar devaluation are the ones who trust the system because they've been told to and who have no idea that the rules have already changed. They're the ones holding their life savings in dollar-denominated accounts thinking they're safe. They need to understand what's coming while there's still time to act. This is not about fear. This is about preparation. The dollar is being replaced. The infrastructure is already operational. The central banks are positioning, and your cash is going to lose 30 to 40% of its purchasing power when this transition accelerates. The only question is whether you're going to recognize the pattern in time to protect yourself or whether you're going to be part of the wealth destruction. The asymmetric opportunity is still open, but the window is narrowing. Make your move while you still can. I'll see you in the next one.